Welcome to today's program titled Ready or Not, Preparing for the Final Roth and Super Catch-up Rules. All participants are in listen-only mode. However, you are encouraged to submit questions throughout the presentation by using the Q&A box on the right-hand side of your screen. For those interested in obtaining CLE credit, a code will be read later in the presentation. Please write this code down as it will not be repeated and is required for the CLE credit request form. During the presentation, you will also see a slide containing a QR code that can be scanned to access and submit your request for CLE credit. You can also find a link to the request form in the connection details email that you recently received. Copies of the program's recording and materials will be distributed to all attendees in the days ahead. At this time, I would like to turn it over to our first speaker, Diane Digert. Diane, you may begin.
Thank you, Sadie, and thank you for scrolling past the legal disclaimer so I don't have to read it out loud. But hopefully everyone incorporated that into their learning today. So again, welcome to our webinar on the recent final regulations on the mandatory Roth catch-up rules, as well as the optional super catch-ups that we'll cover as well. We hope you find the next hour with us worthwhile and enlightening. I should introduce myself first. I am Diane Digert, one of the co-presenters today, and I'm a partner at Cypher Shaw and the chair of our Employee Benefits and Executive Compensation Department. I'm joined today by my partners, Lisa Lazel and Irene Sorcer, both out of our Chicago office as well, and they co-lead our Defined Contribution Plan practice group. So if we can go on to the agenda, we have a few things we want to cover today. Irene is going to start us off with the super catch-up rules and the final regulations gloss on those. And then Lisa is going to walk us through the mandatory Roth catch-up requirement and some new guidance, both welcome and nuanced, that we are gleaning from the final regulations. And then speaking of those nuances, the three of us will attempt to apply the rules from the final regulations to some real-world examples across plans that follow various designs. And as you will see at the end of that, there may be times where applying those rules will necessarily wind up having to do a correction on the back end. And fortunately, the final regulations did provide us with some corrections, and Lisa will explain that relief to us. And then Irene will bring us home by talking about some welcome relief on accumulating or not accumulating wages from related employers in the control group for purposes of these rules. And one last final note before we move on is that all the topics today, these catch-up, super catch-up, mandatory Roth catch-up, apply across the board to defined contribution plans. So whether it's a 401k plan you're interested in, or a 403b plan, or even a 457b plan, these rules all apply. So that being said, I'm going to hand it over to Irene now, who's going to kick us off on super catch-up.
Thanks, Diane. So as Diane mentioned, before we dive into the real meat of today's presentation, which is the new mandatory Roth catch-up requirement, we did want to start with a quick overview of a related provision under Secure 2.0, which we refer to as super catch-up contributions. So Secure 2.0 created a new catch-up contribution limit specifically for employees who are ages 60 to 63. Beginning in 2025, the catch-up limit for this age group increases to the greater of $10,000 or 150% of the regular catch-up limit. So for 2025, that super catch-up limit is $11,250, and it'll be indexed for inflation going forward, much like all the other plan limits we deal with. This provision takes effect in calendar years beginning in 2025, and that is true regardless of the plan year and whether it's a calendar year or an off-cycle year. Importantly, this provision is optional, so it's up to plan sponsors whether or not they want to offer this increased limit to eligible employees. There are a couple of important nuances related to this limit. The first is the universal availability requirement. So under normal rules, catch-up contributions are subject to what's called universal availability. That means that if a plan offers catch-up contributions, it must offer them to all eligible employees and at the same dollar limit. However, the final regulations make an important exception specifically for these super catch-up contributions, and plans are allowed to offer the higher age 60 to 63 catch-up limit without violating universal availability. So, this can be offered even if the standard catch-up limit is applied more broadly. Universal availability, though, does apply in other ways, and specifically, the final catch-up regulations provide that if a plan extends the super catch-up limit, then all other plans maintained by the employer in the control group or affiliated service group must also provide for this increased limit. So, one important thing to look at is whether this provision has been adopted uniformly across all the plans in your control group. On the next slide, we note here that a plan amendment, even though this, provision could be adopted as early as 2025, a plan amendment may be required by December 31st, 2026. So here, the IRS has stated that it expects that the plan's terms will be made clear as to whether or not a reference to the catch-up limit under Code Section 414B in the plan document includes the optional higher limit. So, as a result, what we're taking that to mean is a general reference to Code Section 414B. It's not sufficient to adopt the increased limit. And in fact, a plan that generally references Code Section 414B might be inadvertently capturing that limit when it doesn't intend to. So, I think the takeaway here is to first confirm in terms of administration with your record keeper whether or not this limit is going to be applied, and then carefully review the document to confirm whether or not a plan amendment is required by the end of next year. And with that, I'm going to turn it over to Lisa to introduce the mandatory Roth catch-up requirement.
Sure, and before we go there, we did just get a question in the Q&A box, and feel free to send your questions across via the chat box, and we'll do our best to address them in real time. The first question, Diane and Irene, is whether we have any indication that the IRS is going to issue model language or model amendments for these changes and the other Secure and Secure 2.0 changes. I think it's still an open question. I personally have not heard them signal that they are issuing anything or planning to issue anything.
I don't think anything will be issued before the end of this year.
Yes.
So, and of course, we have till the end of next year to do the amendment. So, I think it's something that people are hoping for, including, attorneys like ourselves are hoping that we'll get model language, even if we have to tweak that model language a little bit, given that we have, roughly 14 months, I guess, before the deadline. There's some hope that they'll do that, but nothing by the end of this year. I think we'll see. And one thing we noodled about this morning, someone just asked as well, and it's this great segue between Irene's portion she just did and Lisa's portion she's about to get to. Irene, should people be worried if they're going to adopt super catch-up that they're going to have to apply the mandatory Roth catch-up requirement that Lisa's going to explain to us?
Yes. So if you adopt super catch-ups and your employee population is subject to the mandatory Roth catch-up requirement, that requirement, which we will discuss in great detail coming up, will extend to these super catch-up contributions as well.
So no good deed goes unpunished.
That's right.
And that's
Thanks, Irene.
All right, Lisa.
Yeah, so with no further ado, let's talk about the Roth catch-up requirement. I'm going to start by providing a general overview of that requirement. First and foremost, the Roth catch-up requirement applies only to participants who earned more than $145,000 in FICA tax wages in the prior year. That limit will be indexed in future years, but for purposes of this mandate that's going to go live January 1, 2026, we are looking at FICA tax wages in excess of $145,000 in the prior calendar year. I did
in
want to
2005, right? This year that we're in now, Lisa.
Yes, in 2025. Yes, that will be we will look back to 2025 for the mandate that goes live January 1, 2026. I did want to note for folks that don't work with these limits every day that this wage cutoff and this compensation definition are different than the wage cutoff and the compensation definition that's used to determine highly compensated employees. So that is just a little bit, I don't want to call it a disconnect because that's overstating it, but now we've got two different groups of people. We've got our traditional highly compensated employees, and then we've got a slightly separate group of people that we need to be concerned with for purposes of this mandate. So that is the group that the mandate applies to. If you also have participants in your plan with less than $145,000 in FICA tax wages for 2025, and I suspect that many of you on this call do have folks that are under that threshold, they are wholly exempt from this mandate. They are not subject to this mandate. They can continue to make catch-ups on a pre-tax basis. What that means in practicality is that a lot of plan sponsors are programming this mandate for a relatively small subset of their population. I have heard from some clients that there's a little bit of confusion on how this mandate applies when you've got folks who are both below 145 and above 45. We just wanted to make it clear that only the folks that are above the $145,000 threshold are subject to this mandate. I wanted to talk briefly about this insight box at the bottom of the page. If your plan does not offer catch-up contributions, you are not obligated to add catch-up contributions to comply with this mandate. You can continue to just keep catch-up contributions out of your plan. That is fine. If you offer catch-up contributions, but you don't currently offer Roth contributions, you have two options for compliance. The first is to add a Roth feature, which I recognize can be easier said than done. The second is to exclude your high earners. So those are the folks that made above $145,000 in FICA tax wages in 2025. You would exclude them from catch-up eligibility for future years. I will note that there are some very nuanced non-discrimination testing issues with that approach. If you are considering that, I encourage you to take a close look at those nuances just to make sure that your solution is going to be compliant with the final regulations, but that is generally an option. I want to talk next about the effective date. Once again, this mandate goes live January 1, 2026. That is the date for both calendar year plans and fiscal year plans. This whole structure runs on a calendar year basis. So even if you have a fiscal year plan, this mandate is going to go live January 1, 2026. However, the final regulations that we're talking about today, strict compliance with those is not required until calendar year 2027. For 2026, we can continue to rely on a good faith interpretation of the proposed regulations that came out earlier this year. So if you are in a position where you've already made some programming changes and perhaps there's a little bit of tension with the final rules that we're talking about, by all means, reach out to your legal counsel and there may be a way to keep your prior programming in place for 2026. I did want to note that there is a special effective date for this mandate for collectively bargained plans. The rule varies a little bit depending on whether the plan is a single employer plan or a multi-employer plan. But in a nutshell, there is a slight extension that aligns with the expiration of the underlying collective bargaining agreement. So if you do have a collectively bargained plan in your world, please take a closer look at that rule because you might have some relief on implementation there. And then before we get into the nitty-gritty of these final regulations, we did want to make it very clear that there is no one-size-fits-all approach for implementation of this mandate. What we're seeing is that the ultimate solution is going to vary greatly between plan sponsors, and it's really heavily dependent on a number of factors. And those factors include how the plan administers catch-up elections today. We'll talk about that a little bit, but there can be a pretty big difference between what's called a spillover approach and a separate election approach. Another big factor is the implementation options that the payroll vendor can accommodate. We are seeing that the payroll vendors in this space have different approaches and different solutions for this mandate. And then last but not least, there is also going to be some variety in which options your third-party record keeper is able to accommodate. So all a long way of saying, I know a lot of you are talking to your not colleagues, but your friends that might be at other companies in this same space. We just wanted to preview for you that the solution that works for company A might not work for company B and vice versa. And that's okay. There really truly is no one size fits all approach for implementation. So next slide, please. Sorry, I lost my webinar here. Okay, this is the vocabulary lesson part of the presentation that Diane previewed. These final regulations that came out are pretty heavy on some important terminology, and we wanted to talk through those before we dove into the specific rules. The first term that we're going to use is high earners. Once again, those are folks earning more than $145,000 in FICA tax wages in the prior year. Once again, that limit might be adjusted in future years, so that $145,000 threshold might change. But for today, let's assume that high earners means people who earned more than $145,000 in FICA tax wages for 2025. The next term
Lisa,
is, yes.
Can I pause you here? Because a few questions have popped up
Sure.
about the FICA wage, about this
Yes.
high earners definition here. So one is confirm that the first indexing would occur next year. So for 2026, we are talking a flat, even, clean
Yes.
145.
That is my understanding. Yes.
Okay.
Flat, even, clean,
Yeah.
145 for
Agreed.
2025. Yes. Agreed.
Got it. Yeah. And then another question was about what goes into the wages that accumulate towards the 145. An example was, do overtime wages count? So could you kind of give us a very high level definition of FICA wages?
Great. Yes. Great question. I think what is easier to preview on this call, instead of going through the specific ins and outs in FICA tax wages, is to note that
Agreed.
your HRIS system or your payroll company is probably capturing that, because those FICA tax wages are reported on the form W-2. I think it's box 3, but don't quote me on that. But one of the boxes on W-2 has the specific FICA tax wage amount. So most plan sponsors have access to that amount. The disconnect that we're seeing is that your third-party 401k record keeper is probably not receiving that amount today. So part of the work here is figuring out how you, the plan sponsor, are going to flag the FICA tax wages in the system and pass that information through to the record keeper.
Yeah. And another related question is, related to who's in the group, what about new hires during the year? So can you talk a bit about like the moment in time we are capturing that population?
Absolutely. So Irene's going to talk a little bit about this. So put, transfers within a larger controlled group to the side. But if you have a true new hire who is brand new to your company, their FICA tax wages start at $0 when they walk in the door. So even if they're a fairly high earner, if they're hired today, for example, they are probably not going to receive $145,000 in FICA tax wages before the end of 2025, and they would be exempt from this mandate for 2026.
And even a new hire, just to elaborate more, in February or March of 26, who again is a high earner, will be exempt from the mandate for 2026, because in looking back to 2025, they didn't have more than $145,000 of FICA wages from our plan sponsor. From our plan sponsor, correct. Yes. Yeah. Similar to. Which Irene will get into more what that means later, but yeah. Mm-hmm.
So similar to a new hire who joins, who may have made 401k contributions to their old employer's plan, there is no obligation to coordinate with that old employer or that employee on those contributions or wages that were made and earned prior to hire by the new company.
So the good thing about this rule, if we can focus on the silver linings, is that once we determine that group on 12/31/2025, they are set in stone for the year. You're not going to be pulling people in and out of that group during 2026. So it's kind of a one-time-a-year decision point.
Unless there's transfers mid-year, but we'll get to that.
Okay, but you'll get into that later. There's always an exception. Okay.
All right. Okay, so we talked about high earners. The next term that I wanted to talk about is the term regular deferrals. Those are the deferrals that participants are generally making towards the 402G limit. And once again, for folks that don't work with these limits every day, the 402G limit is the cap on quote unquote regular contributions that an employee can make to a 401k or 403B plan. And that cap for 2023 is $23,500. That limit is also indexed, so you typically see that go up year to year. We don't have the 2026 limits yet. Hopefully we'll get those soon. But for 2025, that limit is $23,500. Catch-up deferrals are deferrals that are intended to be made in excess of that 402G limit. And once again, as a reminder, in order to be catch-up eligible for the year, you have to be age 50 or older, or you have to have a birthday, a 50th birthday at some point during that calendar year. So for 2026, somebody who's 49 when the year starts, but is going to turn 50 in July of 2026, they are considered catch-up eligible. The standard catch-up limit for 2025 is $7,500. But as Irene noted earlier, if you have implemented the super catch-up option starting in 2025, and you can also do it in later years, you can add it at a later time, that limit is going to be increased for participants ages 60 to 63. Right. Next term is spillover election, and we want to compare that to a separate election. Spillover election is an election. Take a step back. If a participant is catch-up eligible, his or her deferrals will spill over once they hit the 402G limit. And the deferrals after they hit that limit are automatically made as catch-up contributions. Many clients that we work with have their catch-ups set up so that they are using a spillover election approach. And in practicality, the participant only makes a single election, and they just know that that single election is going to spill over into catch-ups once they hit the 402G limit. It's important to contrast that with the separate election approach, which there are lots of other plan sponsors that utilize the separate election approach. And with that approach, the participant is making different elections for both regular contributions and catch-up contributions. And what typically happens is that the plan administers those elections simultaneously so that you have both regular contributions and catch-up contributions going into the plan at the same time. I will put an asterisk on that. There are some plans that do separate elections, but run them consecutively as opposed to concurrently. We will talk about those a little bit at the end, but by and large, the majority of separate election plans run those elections concurrently. And last but not least, a term that we wanted to talk about is the spillover trigger. For folks that have the spillover setup, that is the point at which the regular deferrals hit the 402G limit and would convert to catch-up deferrals for eligible participants. All right, next slide, please. Even more vocabulary. Two terms that you're going to hear a lot in these examples. The first term is the deemed Roth approach, and the second term is the zero-out approach. These are the two primary approaches that a plan sponsor can use for purposes of implementing the Roth catch-up mandate. We are going to discuss both of these approaches in great detail on the following slides, but for purposes of this slide, just understand that by and large, you're going to have to pick one of these approaches or the other. It's not going to be both. The deemed Roth approach is a carryover from the proposed regs. And with the deemed Roth approach, for participants who are subject to the Roth catch-up requirement, the plan sponsor would automatically convert the participant's catch-up election into a Roth catch-up election. So even if they have an old election on the system that says they want to make catch-ups as pre-tax, If a plan sponsor uses the deemed Roth approach, they are automatically going to convert that election to a Roth catch-up election. On the flip side, the zero out approach is an option that plans can use in lieu of the deemed Roth approach. And with the zero out approach, if a participant who is subject to the Roth catch-up requirement has an impermissible pre-tax catch-up contribution election on file, the plan sponsor would simply zero out that election, or in other words, delete that election. And that individual would not be eligible to make catch-up contributions until they affirmatively make a Roth catch-up election. There are pros and cons to both of these approaches. We're going to talk about that in more detail on the following slide. I'm sorry, following slides. Next slide, please. All right, last slide of vocabulary, I promise. These terms are important for plans that ultimately either are considering the deemed Roth approach or ultimately implement the deemed Roth approach. If the plan ends up using the deemed Roth approach, that utilization is contingent upon giving the participant what's called an effective opportunity to make a different election. What does that mean? There's still a little bit of an emerging analysis around what that actually means, but this is what we know it means today. It means that the participant must be given an effective opportunity to turn off their catch-up election, that's choice one, or choice two, make a pre-tax catch-up contribution election. And yes, I realize that second option probably sounds a bit nonsensical, since we just told you that everybody who makes in excess of $145,000 in FICA tax wages is obligated to make any catch-ups on a Roth 401k basis. But we're going to talk through some scenarios that help highlight that second prong in more detail. And then, like I previewed, the final regulations do not provide a lot of clarity on the mechanics of what it means to provide an effective opportunity. We know that it's a facts and circumstances determination. We know that the impacted participants need to be provided with some sort of notice of their effective opportunity, but otherwise we feel like the best practices in this space are still very much evolving. And just to give you an example, if a participant does need to be given an effective opportunity to make a different choice, one of the things that we're grappling with is, how does that choice have to be made? You know, does the choice have to exist on the record keeper's online portal, or can the choice be limited to a phone call into the plan sponsor or the record keeper to request a manual change? Those are the finer points that plan sponsors and record keepers are still working through in real time. And then before I turn it over, next slide, please. Before I turn it over to Irene and Diane for some of the examples, I wanted to touch very briefly on Puerto Rico plans. If you have a Puerto Rico only plan, it is wholly exempt from this mandate. If you have a dual qualified plan, the Puerto Rico participants in that plan today are exempt from that mandate for now. If the Puerto Rico tax code is ever amended to add a Roth 401k feature, however, this mandate will also come online for your Puerto Rico folks. So Diane and Irene, I am going to turn it over to you for the examples.
Oh, great. I guess I'm off mute. I was thinking I was on mute. Let's try to apply. I'm getting a number of questions in our Q&A box about this and how it applies to certain people, both types of contributions, and that hopefully we will, by going through these examples, get the answers to some of your questions that have been raised, because we had the same questions as we were looking through these regulations ourselves. So one baseline before we actually start the examples, one thing to talk about, just to make sure we're all on the same page, is the final regulations make clear that spillover plans, so remember those kind of plans Lisa was talking about where the participants make a single election, and when they hit the 402G, they flip over to catch-ups if they're over 50, if they're catch-up eligible. We historically, right, have thought of those, that spillover trigger is happening when both the pre-tax and the Roth together hit the 402G, because that is what's legally required in order to, have the extra counted as catch-up. But for purposes of applying the deemed Roth election, where you say, even though you had a pre-tax catch-up election in place, we're going to deem it to be Roth so we can be compliant. For that to occur, you have a choice now. You can either count just pre-tax only deferrals towards that 402G limit, ignoring the normal process where we've included Roth in the past, or you can kind of continue looking at both pre-tax and Roth as to when that spillover trigger is going to happen for purposes of applying the deemed Roth, switching their pre-tax catch-up election to a Roth election. The regs make clear you can do this, but they're not for spillover plans. They're not so clear on whether you can apply this to zero-out plans, but zero-out plans will need to know as well, or I'm sorry, it applies to spillover plans who do the deemed election. It's not as clear about whether you apply it to spillover plans that do the zero-out as opposed to deemed. But you do need to figure this out, right? Because at some point you're changing. You're either deeming it to be Roth or you're turning it off. So when that applies, whether it's pre-tax only or pre-tax plus Roth towards that 402G, you still need to make the same decision as to how you're going to program your plan. And we think that would work whether you do deemed Roth or zero out, that you can have either of these choices under either plan. Notice I'm not really talking about separate election plans here, because you can actually apply your deemed or your zero out approach at the beginning of the year to that separate catch-up election, because that's a standalone election. It's not, we're not changing that one single election at some point. We're looking at the regular and the catch-up elections separately from the get-go. All right, so let's flip over to the next slide, and we're going to approach our examples in this kind of four-quadrant fashion here. Your plan is going to fit into one of these four quadrants, right? So you're either, you have to think about, are we a spillover approach plan or are we a separate election approach plan? And once you've figured that out, that determines what row you're in. And then for purposes of this mandatory Roth catch-up requirement, are we going to apply the deemed Roth approach and flip people over to Roth from their pre-tax, or are we going to apply the zero-out approach and just turn off their pre-tax catch-up elections? So where it's not a Venn diagram overlapping, right? You got to be in one of these four quadrants here. So we're going to go through examples in each of these quadrants. And we're going to start with kind of the upper left quadrant we call scenario one, which is spillover with deemed Roth. And one other thing to keep in mind is that in all our examples, all our participants are going to be high earners who are subject to the mandatory Roth requirement. So we're not going to repeat that in every example, but just keep that assumption in mind. So example one, we're going to start with the easy example. We think it's the easiest one. This is where a plan is a spillover plan, and they're going to do the deemed Roth. In our example, Martin, our first participant, he has a standing election of 15% contributions, right? And he's made it on a pre-tax basis. So his contribution, comes out as pre-tax at some point during the year. Assume Martin makes enough that putting away 15%, he hits the 402G limit. At that point, that's when we would trigger the deemed Roth, right? So we change his pre-tax into a deemed Roth, and we're good. That's kind of all we have to do, because he's maxed out under any possible scenario the most pre-tax he can put in. He hit the 402G limit for that year on only pre-tax. If he wants to keep putting contributions in, they're going to be catch-ups are going to have to be made as Roth. So no real need to apply an effective opportunity here. Martin, of course, can go in whenever he wants and turn off his catch-up before or after it got to the point where it flipped over to Roth, but prospectively, right? Almost every plan I know of would allow you to turn off your contributions, for the next administratively feasible payroll cycle. So this one is easy. We've made this a green stoplight. All systems go for Martin in scenario 1. But let's go over to the next slide and talk about Daphne in example 2. So we're just going to add a slight complication here to our fact pattern. Daphne's deferral contribution election is split, right? So she's putting in 10% pre-tax and then another 2% as Roth. So 12% is coming out of her paycheck each month, but most of it's pre-tax, some of it's Roth. The first kind of approach, we're going to assume for this example that the plan has been programmed to only count her pre-tax deferrals towards that 402G limit. So they're going to, in this scenario, allow her to get in the most pre-tax she can all the way up to the 402G limit, $23,500 in 2025, be a different number next year. And when it hits that number, then we're going to flip her entire election now over to Roth because it's got to be catch up now, and therefore it has to go in as Roth. Daphne in this example is not going to have an effective opportunity to change that to pre-tax because she's maxed out on her pre-tax, the way we've counted that trigger point. Daphne will have an opportunity to stop making catch-up completely. So in that sense, she's just like Martin, right? Her only choice is to turn off her ongoing deferrals once she hit that catch-up level because she can't make it as pre-tax anymore. So the only reason our stoplight is yellow here instead of green is just to acknowledge the issue some payroll systems would have in programming kind of against the historical norm and just looking at pre-tax towards that 402G trigger point for applying the deemed Roth. But if you can do that, or you've already decided you can do that and make steps to doing that, then our stoplight would turn to green. So it's really just to acknowledge that there might be some payroll issues here. So let's go over to example 3. We're sticking with Daphne in example 3, but we're looking at a different plan approach. In this plan approach, the plan's decided that they're going to count both pre-tax and Roth towards when that 402G limit has been hit for purposes of deeming the contribution and changing the contribution from pre-tax to Roth. So here, she's going to hit that deemed point a little earlier because her Roth is going to be added to her pre-tax to determine when she hits the $23,500. I'm just going to use that number, even though I know it's going to be different next year. So in this case, her effective opportunity, she has 2 choices that we have to allow her to do. One is that she could just turn it off, just like Martin and Daphne in example 2. Or she can say, I want more to go in as pre-tax. So I want some of my ongoing contributions, which are now catch-up, keep in mind, but I want them made as pre-tax because I have room to make pre-tax because some of my regular was really Roth. So kind of recharacterize some of my earlier Roth regular as Roth catch-up so I have more room to put in pre-tax. To me, this is an extra level. It's still yellow like the slide before, but it's like a deeper yellow. Just because you have the same programming issue as to what you're going to count towards where that trigger point happens. But you also have the issue of can our systems allow someone to make a pre-tax catch-up, when they're in a high earner group where otherwise that would be blocked, right? So, and we'll kind of talk about ways if you can't do that, how might we fix it at the end. But that's kind of our kind of deeper yellow than, I guess, slide 2 before that. So that's scenario 1, deemed Roth with spillover. I'm going to hand it over to Irene, and we're going to move over to the next scenario, sticking with spillover plans, but going to zero out.
Thanks, Diane. So again, a zero out plan is one where when a participant reaches their 402G limit, instead of flipping their election from pre-tax to Roth, we're instead going to cancel any pre-tax catch-up election in the case of a high earner. So we'll talk through a couple examples there of how that looks. In our first example, we have Eddie, and he makes a pre-tax regular deferral election of 15% of eligible pay. So, normally with a spillover election, this election would just continue until the participant reaches their combined 402G and catch-up limit. But under the zero out approach, the plan will automatically cancel Eddie's pre-tax selection once Eddie hits the 402G limit. Because Eddie only elected pre-tax deferrals and contributes the maximum amount of pre-tax deferrals he's permitted to as a high earner under the plan, this example is pretty straightforward. Of course, if Eddie wants to continue deferring catch-up contributions to the plan, he'll be able to go in and make a new Roth catch-up election. So while this approach works, we do want to note that it may constrain participants from deferring the maximum amount they intend to under the plan, and communication about the fact that this election is going to be zeroed out is critical. In the next example 5, we're going to switch to Kenny. And in this case, Kenny makes a pre-tax deferral election of 10% of his eligible pay and also a Roth deferral election of 2% of his eligible pay. So again, under normal circumstances, his 12% combined deferral election would continue until he hits the combined 402G and 414 limits. But again, because we have this mandatory Roth requirement, once Kenny hits that 402G limit, and again, there's a decision point here on what triggers that 402G limit, whether it's just pre-tax deferrals only or combined pre-tax and Roth. But at that point, his pre-tax deferral election would be canceled, and only the 2% Roth deferral election would continue. So as in the example before, if Kenny does not increase his Roth catch-up election, he may not defer his intended amount into the plan for the year. And moreover, because the plan zeroes out an election, if the plan zeroes out the election at the combined pre-tax and Roth deferral hitting the 402G limit, it's going to artificially constrain Kenny from deferring the maximum amount that he intended as pre-tax or that he could have contributed as pre-tax. And so for that reason, we switched the stoplight over to yellow because you could foresee a situation where participants, wish they could have contribute more in pre-tax than what the plan permitted them to. One last thing I'll note is, as with the last example, if the participant's pre-tax election is zeroed out, once they hit the 402G limit, the plan can still allow them to go in and increase their Roth catch-up election. And under this approach, the plan is not required to offer an effective opportunity for the participant to switch their election back, because again, the effective opportunity requirement only applies in the case of the deemed Roth approach. So with that, I'm going to turn it over to Lisa to discuss the separate election approach.
Thanks, Irene. So I am going to talk about the scenario where a client utilizes separate elections for catch-ups and chooses to implement or is considering implementation of the deemed Roth approach. So next slide, please. All right, so we've got Lana here as our next participant. Lana makes a 10% pre-tax election for both regular and catch-up deferrals. Now, because this is a separate election plan, we are going to assume that the separate catch-up election runs simultaneous to the regular deferral election. So what that would mean is that the 10% catch-up is coming out of their paycheck at the same time as the 10% regular deferral election. There is an effective opportunity issue here that we're going to talk about on the next slide, but I wanted to focus on a second point here, which is some nice relief for these separate election plans. The final regulations are clear that if you have separate elections and you use the deemed approach, the plan sponsor is under no obligation to go back and reclassify any catch-up contributions that are deemed to be Roth as pre-tax contributions. So, for example, let's pretend that Lana is making $150,000. She has a 10% pre-tax election. And this separate 10% catch-up election, which we deem to be Roth, and let's just pretend that she doesn't try to change that mid-year. That just keeps going as a deemed Roth election. She is going to end up at the end of the year with $15,000 in her regular bucket and another $7,500 in her Roth catch-up bucket. The final regulations are very clear that the plan sponsor has no obligation to go back and characterize any of those Roth contributions as pre-tax, even though she theoretically has room in her 402G bucket. So that is some nice relief that is provided by the final regulations. Now, the complicating issue with this is the effective opportunity, which I'm going to talk about on the next slide, because I think that example does a better job of illustrating it. But before we go to the next slide, another piece that I wanted to talk about, we've been talking to some clients that do have this separate election approach that runs simultaneous to the regular election. And there is some concern that come the first January payroll, we actually aren't going to have the final FICA wage amounts for 2025 and won't actually know who is subject to this mandate. If you are thinking about your options and you have separate elections and you think you are potentially in that boat, by all means reach out, because we've been brainstorming a couple of options that plan sponsors might be able to use to navigate that potential administrative hurdle. So with that, let's move to the next slide. All right. So here we've got Niles. Niles makes a 10% Roth regular deferral election and a 2% pre-tax catch-up deferral election. Because this plan is using the deemed Roth approach, the plan is going to treat Niles' 2% pre-tax catch-up election as a Roth catch-up election from day one. That money is just going to go in as Roth. Now, because of this effective opportunity requirement that is in the regs, Niles theoretically has the ability to count those Roth 401k contributions that he's making to his regular bucket towards his Roth catch-up mandate. And therefore, he needs to be given an effective opportunity to switch his Roth catch-up election back to pre-tax. So once again, we have to give him the effective opportunity to make that change. I think it's still an emerging space what that effective opportunity is going to look like. But if you are considering this deemed approach, by all means, please talk to both your payroll vendor and your record keeper to understand A, if this effective opportunity is administratively feasible, and B, what that's going to look like. And that's the reason for the red stoplight here, is that we just don't yet have full insight into how, you know, the industry as a whole is really going to handle that effective opportunity process. I think that is it for these two examples. So Diane, I'm going to flip it to you for the last scenario.
I'll toss mute. Okay, all right. We are going to move over to scenario 4, which is plans following a separate election approach and zeroing out the catch-up election, if applicable, which is my personal favorite scenario. All right, so next slide, please. Example 8. In example 8, I like this because it's green lights, I guess. Example 8, Gil, in our situation, makes a 10% pre-tax election for his regular and a 10% pre-tax election for his catch-up. So he's 20% going out of his plan. This is a concurrent separate election scenario. In this case, the plan is just going to ignore Gil's catch-up election, right, his pre-tax catch-up election. They're going to zero that out before the first deduction even comes out of his 2026 paycheck, right? So, and that's okay. We can't take that into account because Gil's subject to the mandatory Roth catch-up requirement, and his freestanding catch-up election is pre-tax, which we cannot follow, and we're not going to deem it. We're going to zero it out. We can do that, and everything's going to go smoothly with Gil's scenario here in this plan. So moving on, though, to examples, it's still the same scenario, but with a slightly different approach here as to how the plan's designed. Some separate election plans, we've been kind of focused on separate election plans that come out concurrently immediately in January. Other plans that are separate election plans run them consecutively, right? So your regular election is coming out during the year. When you hit the 402G, then the plan will look at to see if you made a separate catch-up election or not and start applying that. Turn off your regular election, start applying your catch-up election. It's different than a spillover plan in that they are two separate freestanding elections. They just apply consecutively one after the other. And some plans establish themselves that way. In these cases, that separate catch-up election, again, isn't going to apply until after the 402G limit is hit. And when would that be? Also raises that specter of that question. When we program, well, when that would be. So in example 9, we're going to take Frazier. Frazier makes a 10% pre-tax regular deferral election, and then separately he's making a pre-tax catch-up deferral election for 5%. So 10% regular, that goes by itself for a while, and then when he hits that 402G limit, 5% catch-up starts going in place. Because his regular election is all pre-tax, when he hits the 402G limit, he is maxed out on everything he can put in the plan on a pre-tax basis, right? So we're just going to ignore his pre-tax catch-up election because we're a zero-out plan in this scenario. We're not going to deem him to be Roth. Everything's fine for Frazier here. But let's say that instead the plan is set up to, or Frazier's election is that his regular deferral election was for Roth, not for pre-tax. So his regular election was Roth, and for whatever reason, his catch-up election was pre-tax. So if that's the scenario, the same thing's going to happen, right? We're going to just count his regular election until he hits the 402G, even though it's all going in as Roth, and then we're going to ignore his catch-up election for pre-tax. Our light is yellow here for the same reason, and I think it was one of Irene's examples. Nothing wrong with the plan or risk for the plan really here, except that our participant Frazier is going to artificially be constrained to how much he can put in the plan because of his own elections, right? Because he decided to make his regular Roth instead of pre-tax, he's going to be limited as to how much he can sock away in the plan. So in that sense, it's yellow, but not really from a programming standpoint, more from a participant communication and education standpoint, which kind of leads us to the next part of our presentation. You can see by these examples, and admittedly, we have not been able to tackle every potential nuance. I see a lot of questions come in, what about this, what about that, just with the time constraints we have here. But you can see by these that a big key of how you set up your plan and how well it runs in 2026 is how well we educate our participants as to the impact of the choices they make under, which of these 4 quadrants our plan is going to be set up in. But even if they don't make decisions that are the best for administration, we do have correction procedures available. So next, if we can flip to the next slide, I'm going to turn it over to Lisa to walk us through the correction that the regs give us. And Lisa, I do see we are running much shorter on time, trying to get to people's questions.
It's going to be, yeah,
threw us off our timeline.
Turbo review. So next slide, please. So one of the big differentiations between the deemed approach and the zero out approach is that for plans that have adopted the deemed approach, there is very liberal correction relief available in the regulations. And there are 2 primary methods. The first is if you kind of catch the error in real time or before the W-2 for the year goes out, you can, convert that erroneous pre-tax contribution to Roth and report it as Roth on the participant's form W-2, move it behind the scenes, and it's corrected. Another option, either this is more palatable or you catch it in the later in the year, you can actually roll over the pre-tax amount to Roth in the plan. And then the tax impact of that gets reported on a 1099-R that will be issued in conjunction with that correction. Both of these corrections result in taxable income to the participant without corresponding withholding. So I think, think about that, right? Like, even though it's correctable, not a great result to have taxable income without corresponding withholding. And then last but not least, the regs are clear that you have to provide the selected correction method consistently. So the extreme example of this, if you've got an error that impacts, 20 people, you can't go out to each one of them and ask how they want it corrected individually for them. You need to pick an approach and stick with it for the impacted group. Next slide. And then for plans without the deemed approach, so those plans that use the zero out approach, there are probably still going to be errors, right? Somebody's not going to get zeroed out as intended. There's probably still going to be errors. The correction relief with that option is far more limited. The big correction option is just distributing out the catch-up contributions that were erroneously made on a pre-tax basis. That distribution would also be reported on a 1099-R. The bad news there, in addition to creating some taxable income, it also results in the loss of a catch-up contribution opportunity for the participant. And then last but not least, even with the zero out approach, you've still got EPCRS available to you. EPCRS is admittedly a bit in flux right now. We haven't seen the latest version yet. But the correction options in there specific to this error, we think are pretty limited as things stand today. So correction with the zero out approach is more constrained. I think I'm going to skip this slide. These materials are going to be distributed after the call. These are the exceptions that might apply. But I want to give Irene the last 3 minutes to bring us home on the new aggregation of employer rules. So thank you, Irene.
Yeah, thank you. We did receive a lot of questions about this in the chat box, so we do want to cover this topic before we set you loose and to return to your work days. So, the question is, what employer compensation is counted towards this 145,000 FICA wage limit? Under the proposed regulations, this was a very complicated response. The term employer was interpreted very narrowly, and it referred only to the participant's common law employer. In other words, the specific entity the participant is working for that's participating in the plan. As a result, wages were not aggregated across related employers within the control group. And if an employee works for multiple entities in the prior year, only the wages from the direct employer counted towards this limit. So you could imagine a scenario where an employee is transferring between employers and the plan has to turn on and off this mandatory Roth requirement, which is, again, pretty complex to administer. The final regulations, however, allow us to take a much broader approach. So now the term employer can include not just the employee's common law employer, but also any related employers within the control group or affiliated service group. And so that means that wages can now be aggregated across related employers for purposes of determining whether the employee's FICA wage limit exceeds the Roth catch-up threshold. The final regulations also clarify that, there's a lot of discretion here, right? So, we can aggregate only certain employers within the control group. We can aggregate all employers, or, in some cases, an employer may choose not to aggregate. So there are a couple key takeaways here. First, consider whether and how FICA wages will be aggregated for purposes of this requirement. Will it be done on a payroll system, on a plan-by-plan basis, or some other method? Our thought is that while aggregating across payroll systems or EINs may create more front-end work, it might ease some administration on the back end, when employees do transfer between entities. And then the second point is the regulations do provide that the plan document needs to specify how wages are aggregated for this purpose. So make sure, next year when we're all frantically working on our year-end amendments for these requirements, that we address this point. And so, we are at time, and we are also at the time to give you your CLE code.
Yes, and you can use the handy dandy if you're looking at this on your video screen. You can use the handy dandy QR scan code, scan it. It'll take you to a CLE form you can fill out and submit for credit. If you're listening orally, I can read the code out loud for you and create your own form. The attendance verification code for today is SS, which stands for Seifert Shaw. So SS2002. So again, SS2002. All right, and thank you very much for joining us today. We're sorry our time was constrained to an hour. As you can tell, there is so much to cover and we barely scratched the surface, but appreciate everyone's attendance. Thanks.